Let's say it happens. You took a big first-year deduction from a cost segregation study, and a letter shows up from the IRS. They want to take a look at it. Most people's stomach drops at that sentence. So let me say the thing that nobody says first. An audit is not an accusation. It's a request for support. The IRS is asking one basic question. Can you back up the numbers you put on your return? If the answer is yes, an exam is paperwork. If the answer is no, it's expensive. And the difference between those two outcomes is decided long before the letter ever arrives in your mailbox. Today, I'll show you exactly what makes the difference.
Welcome to the Tax Strategy Playbook, the show where smart investors, business owners, and real estate pros learn how to win the game the IRS wrote. Each episode, we break down powerful strategies, expert insights, and real-world examples that help you keep more of what you earn. Because here, it's not about working harder, it's about working smarter with your taxes, because tax evasion is a crime, but tax avoidance is mandatory.
Welcome back to the Tax Strategy Playbook. I'm your host, David Weiner, Mr. Cashflow, and this show exists to help you keep more of your money and sleep well doing it. Here's the roadmap. I'm going to walk you through why cost segregation studies can draw a second look in the first place, what an examiner is actually trained to check, the 5 documents that turn an audit into a formality, what happens when those documents aren't there, and how to pass the whole test before it's ever given. Not to scare you, to prepare you. If you own property, or you're about to, this is the episode that lets you stop worrying about the IRS and start being ready for it. So subscribe and keep it handy. First, you need to understand why these studies draw attention at all. A cost segregation study can turn $20,000 of first-year deductions into $300,000. That's a dramatic swing, and the IRS knows the difference between a study done right and one done on the cheap. So they're not hostile to cost segregation, not at all. It's a completely legitimate, well-established strategy. They just want to confirm that yours was done properly. In fact, the IRS publishes its own internal guide that tells its examiners how to evaluate these studies. That's good news for you, because it means the rules of the game are knowable. We're not guessing what they'll ask. We basically have the test in advance. Let me give you the single most empowering fact in this entire episode. The IRS guide I just mentioned has a name and a number. It's the Cost Segregation Audit Techniques Guide, publication 5653. And it was last updated in early 2025. It's not secret. It's published. Anybody can read it. It is quite literally the training manual the IRS uses to evaluate studies like yours. And here's why that matters so much. Most areas of tax feel like a black box. You take a position and you hope. Cost segregation is different. The IRS has told you in writing exactly what a quality study looks like. They describe what they call the principal elements of a quality cost segregation study, 13 of them to be exact. 13 things that, when your study has them, make it the kind of study that holds up under scrutiny. I'm not going to read you all 13 line by line. That would put you to sleep. But let me give you the spirit of them grouped into what they're really asking. Number 1, who did this and are they qualified? Preparation by someone with real engineering and tax experience and expertise. Secondly, what method did they use? A detailed, documented methodology, not a rule of thumb. Do the numbers tie out? Costs reconciled to your actual total basis using a sound cost estimating approach. Is each asset justified? A complete listing of reclassified assets with the rationale and legal authority for each one. Is it about your building? Photographs, drawings, specific descriptions of the actual components of your building. And finally, does it match your return? Consistency between the study and how you actually depreciate the assets. When an examiner opens your study, they're checking it against these 13 elements. So the winning move is obvious. Make sure your study was built to satisfy them in the first place. You don't study for this test the night before. You buy a study that already passes it. When an examiner opens your study, they're looking for a few specific things. Let me translate them out of IRS speak. The first question is about the preparer. Who did this and are they qualified? Cost segregation sits at the intersection of engineering and tax law. The examiner wants to see that whoever did your study actually had the expertise to identify and classify building components, not just somebody who ran software and printed a result. A study from a qualified engineering-based preparer carries weight before they even read page 2. A study from an unclear source starts on its back foot. Number 2, how were the components classified? This is the heart of it. The examiner looks at how each piece of the building was identified and assigned to 5, 7, 15, or 39-year categories. They want a methodology, a logical, documented approach, not a percentage pulled from an average. Buildings like this usually have 20% short-life property is not a methodology. Here's each component, here's why it qualifies, here's the cost. That is a methodology. Third, do the costs reconcile? The numbers in the study have to tie back to reality, what you actually paid for the property, and where relevant to construction or renovation records. If the study claims a dollar figure for a component, there should be a basis for that figure. The examiner is checking that the math reconciles to your actual cost, not to a model. Number 4, is your building specifically documented? Finally, they want evidence that the study is about your property, not a property in general like yours. Photographs, drawings, descriptions of the actual components being classified. This is where the cheap DIY or no inspection study falls apart. If nobody ever looked at the building, there's nothing here to show. Okay, here's the practical core of the episode. If you take one thing away, take this list. These are the things that, when they exist, turn an audit into a formality. First is the cost segregation report itself, a complete engineering-based study that lays out every reclassified component, the method used, and the cost assigned to each. This is Exhibit 1. Secondly, proof of the preparer's qualifications. Evidence that the person who did the study has the engineering and tax expertise to do it. Credibility of the source matters. Third, your purchase and cost documentation, the closing statement, the purchase price allocation, any construction or renovation invoices the study relied on. This is what the numbers reconcile back to. Fourth, photographs and building records, the visual and physical evidence that the components in the report actually do exist in your building. Photos, blueprints, property descriptions. And then fifth, your depreciation schedules, the record showing how you actually carried these assets on your return consistent with the study. The study and your tax return need to tell the exact same story. Notice that every one of these comes from doing the study right in the first place. You don't assemble an audit defense after the letter arrives. You either bought it the day you commissioned the study, or you didn't. This list is the most savable thing in the episode, so if it's useful, hit like so the next investor finds it, and comment the word folder if you want me to do a follow-up on exactly how to organize the 5 documents. If enough of you do, that'll be a future episode. Let me demystify the process itself, because the fear usually comes from not knowing what happens. An exam is not a raid, it's a sequence, and it's slower and it's much more paperwork driven than the movies suggest. It starts with a notice in the mail, never a phone call out of the blue, and never a text or email. The letter tells you your return or specific items on it are being examined. If you took a big cost segregation deduction, that's often the item that they're looking at. Take a breath. This is a request. It's not a verdict. The examiner sends what's called an information document request, or an IDR. It's a list of the documents they want to see. For a cost seg study, this is where they ask for the study, your cost records, your depreciation schedules, the support behind the deduction. This is the whole ball game. And notice what it is: a request for documents. If you have them organized and ready, this step is almost anticlimactic. You send the folder. The examiner reviews what you sent against the 13 elements we talked about. Do the costs reconcile? Is there a methodology? Is the preparer qualified? Is the building documented? They may come back with follow-up questions, and this back and forth is normal. It's not a sign that you're in trouble. It's not a sign that they're trying to pin something on you. It's how the process works. Your provider's audit support, if you bought a real study, is enormously valuable right here, because they can speak directly to their own methodology. One of a few things happens at that point. Best case, and the common case for a solid study, they accept it as filed and you move on, deduction intact. They might propose an adjustment, which you can agree or dispute. And if you disagree, you have rights. You can request a conference with the IRS Appeals, an independent party of the agency, before anything is final. The system has off-ramps. It's not their word against yours, and you're done. The entire thing can take months. It is mostly a documentation exercise stretched over time, which is exactly why the work you did or didn't do when you commissioned the study is what decides the outcome. Let's be honest about the other side. If the study can't support its numbers, the examiner can reclassify those components back to the standard 39 or 27.5-year schedule. Practically, that means that the big first-year deduction you took gets unwound. You'd owe the tax you deferred, and depending on the situation, penalties and interest, significant penalties and interests, can ride along on top. Let me be specific about those penalties, because this is where a few thousand saved on a study turns really ugly. Beyond paying back the deferred tax with interest, the IRS can assess an accuracy-related penalty, commonly 20% of the underpayment when a position isn't adequately supported. So you don't just give back the deduction, you give it back, plus interest that's been compounding since you filed, plus potentially a penalty on top. That's the $50,000 swing in real terms. It's never just the tax. It's the tax, the time, and the penalty all stacked together. And here's the painful part. It's often not because the strategy was wrong. The investor was usually entitled to most of those deductions. They just couldn't prove it, because the study they bought was never built to be proven. The deduction was real, the support wasn't. Let me make this all human with a composite. Two investors, same situation, opposite outcomes. These are not specific clients. They're a representative picture of what I see play out. Investor A bought a commercial building and wanted to do things right. She hired an engineering-based firm. Someone documented her property, photographed the components, built a methodology, reconciled the costs to her closing statement, and delivered a full report. She put the report, her closing documents, her depreciation schedules in one folder, stuck it in her desk, and forgot about it. 2 years later, the letter came. The IDR asked for her support. She opened the folder, sent it, answered 2 follow-up questions through her CPA and the cost seg firm, and the exam closed with her deductions intact. From her side, it was a few hours of forwarding documents. She was never scared because there was nothing to be scared of. The work was already done. Investor B bought a similar building and took a similar deduction, but he bought a cheap cost segregation study to save money. No site inspection, no photos, a percentage applied to his purchase price, delivered as a PDF in the same afternoon. Same letter, same IDR, but when he went to respond, there was nothing in the folder. No methodology, no building documentation, no reconciliation, no firm willing to stand behind the work. The examiner reclassified the components back to the 39-year schedule. He owed the deferred tax plus interest, plus an accuracy-related penalty. He was entitled to most of those deductions, but he couldn't prove it. The strategy didn't fail him. The documentation did. The lesson is, same building, same deduction, same letter. The only variable is the study they bought on day one. That single decision, made years before the IRS ever showed up, determined whether the audit was a formality or a five-figure loss. So which investor do you want to be when the letter comes? Obvious, I know. But here's the real question. Are you actually set up like investor A right now? If you're not sure, that's worth knowing today, not in 2 years. Comment A if you're confident your documentation would hold, or B if you've got a nagging feeling it wouldn't. And like this if the story made the stakes click. Two more things that take the fear down a notch, because knowledge is the antidote to dread here. First, exams come in different sizes. Many are handled entirely by mail, a correspondence exam, where you simply send documents and never sit across from anyone. Some are conducted at an IRS office, and the most involved are field exams. For a documentation question like a cost segregation study, a lot of it comes down to sending in the support, not a dramatic face-to-face interrogation. The mental image most people have is far more intense than the typical reality. Second, and this matters, you have rights throughout. There's a published Taxpayer Bill of Rights, and among other things, it means that you have the right to professional representation. Your CPA or tax advisor can deal with the IRS, so you don't have to. You have the right to understand why information is being requested and what the IRS intends to do with it. And if you disagree with a proposed adjustment, you have the right to appeal to an independent IRS appeals office before anything becomes final. This is not a system where one person decides and you're stuck. There are checks and there are off-ramps at every stage. But none of that replaces having a defensible study. It's far better to win on the documents than to fight on appeal. But understanding that the process is structured, bounded, and gives you rights is what lets you replace panic with preparation. The IRS is not trying to trap you. They're asking you to support a number. Support it, and the process works out the way it's supposed to. Since the test is knowable, you can pass it before it's ever given. 3 things. Use an engineering-based study from a qualified preparer from the start. This single choice satisfied most of what an examiner checks. Secondly, keep your records together. The closing statement, the study, the photos, the depreciation schedules, one folder, so that if the question ever comes, the answer's already assembled. And then third, make sure your return matches your study. The depreciation you claim should line up with what the study supports. Consistency is its own form of credibility. And a lot of you asked for this, so let me make it concrete. Don't wait for a letter to go hunting for documents across email, your closing attorney, and 3 different cloud drives. Build one folder now, physical or digital, doesn't matter, and put these things in it the day you finish a study. Put in the complete cost segregation report, including the methodology section, the component schedule, the photographs, and the legal authority. It should all be in one document anyway. Put in your closing statement and the purchase price allocation, the land versus building split, and where it came from. You may need to defend that. Put in construction or renovation records if you have them, contractor invoices, draws, change orders, drawings. Put in the depreciation schedules from your tax return, showing how the assets are actually being carried. And put in the provider's qualifications and their audit support commitment in writing, plus their contact information. That's it. If the IRS ever sends an IDR, your response is, open the folder, send the folder. That's it. The investors who panic during an audit are the ones assembling this from scratch under a deadline. The investors who breezed through built the folder while they were already thinking about it, which is right now. If you're going to build that folder this week, comment "done" when you do. I love seeing people actually take that step instead of just nodding along with me as we go through it. And if this gave you a concrete action instead of just anxiety, hit like so that it reaches the next investor who needs it. We've talked a lot about what a winning study looks like. Let me flip it and dissect a losing one, because seeing the failure modes up close makes the standard concrete. Here's what an examiner sees when the study falls apart, point by point. It opens with no clear preparer credentials. There's no licensed engineer named, no description of who did the analysis or what qualified them to do it. Already the examiner is skeptical because the first one of those 13 elements, qualified preparation isn't met on page 1. Then the methodology section is thin or missing. Instead of here is each component and why it's 5-year property, there's a statement that a percentage was applied based on typical properties. The examiner asks the question they're trained to ask, typical according to what? There's no answer because there was no analysis of this building, just a benchmark. Next, the costs don't reconcile cleanly. The numbers don't tie back to the closing statement or to the construction records in a way the examiner can follow. Maybe they roughly add up, but there's no traceable path from the purchase price to the component costs. This reconciliation element fails. And critically, there are no photographs, no drawings, nothing showing the actual building. Nobody inspected it, so there's nothing to show. The element that proves the study is about your property simply isn't there. To the examiner, this could be a study of any building anywhere, which means it's a study of nothing in particular. Put those failures together and you see why this deduction gets unwound. It's not that the investor wasn't entitled to accelerate that property, they probably were. It's that the report can't prove any of it. Every one of those failure points traces back to the same root cause, a study built to generate a number cheaply, not to defend one credibly. That losing study isn't unlucky, it was just structurally incapable of winning from the day it was created. A study loses for predictable reasons, and every one of them is decided before you ever file, which means a study wins for predictable reasons too. You're not gambling on an audit. You're choosing on day one what kind of study you'll be holding when the question comes. That breakdown of how a study fails. Useful? If you want me to make a companion episode walking through exactly what a winning report contains, section by section, comment winning report. I'll build it if there's interest, and a like helps me know this kind of deep dive is landing with people. Let me take care of some listener questions about audits, because I get them all the time. First, does taking a cost seg deduction make me more likely to be audited? That is a common myth about cost segregation. But a large deduction can draw attention, sure. But a properly documented engineering-based study is a normal, legitimate thing the IRS sees all the time. What actually creates risk is a big deduction with thin support. The strategy itself isn't a red flag. Weak proof is. Number 2 is how long do I need to keep all this? Keeping your cost seg records for as long as the asset matters to your return, which with depreciation is a long time. Practically, hold the study and supporting documents for the life you're depreciating the property, plus the years afterward that a return can still be examined. When in doubt, keep it. It's a folder, it's cheap to store, and it's expensive to lose. What if I already took a deduction on a weak study? Don't panic. Don't ignore it. Talk to your tax professional about getting a proper engineering-based study done to shore up the position. It's far better to strengthen your support before a letter arrives than to scramble after one does. A good firm can often review what you have and tell you honestly whether it would hold up. If you need that, contact me directly and I can help you get it. Do I have to face the IRS alone? No. Your tax professional represents you, and if you used a real cost seg firm, a quality cost seg firm, their audit support means they help defend their own methodology. You're not standing there explaining engineering you didn't do. That's a big part of what you're paying for when you buy the right study. Make sure that in writing it tells you that they will defend their study in audit as long as it takes for no additional charge. Whatever your biggest IRS fear is, put it in the comments. I read them all, and the questions that come up most become full episodes. And if this one took some weight off your shoulders, please subscribe so the next investor who's nervous finds it too. Here's your takeaways from this episode. An audit is a request for support, not an accusation. Documentation is the whole game. The IRS tells its examiners what to look for. Qualified preparer, real methodology, costs that reconcile, your building documented. You can meet that standard on purpose. The 5 documents that save you all come from doing the study right up front. You can't manufacture them later. And a disallowed deduction usually isn't a strategy that was wrong. It's a deduction that couldn't be proven. So if you ever get that letter, here's what I want you to feel. Not panic, readiness. An audit of a properly done cost segregation study is a paperwork exercise. You hand over the report, the records reconcile, and you move on with your deductions intact. The investors who suffer are the ones who bought a number instead of a defensible study. Don't be that investor. Here are your next steps in the playbook. Step 1. Doing engineering-based studies that are built to hold up under exactly this kind of review is what my team does, along with 179D look-back and R&D studies. We don't do full tax planning beyond those 3. When you need that, I'm glad to refer you to a tax professional who handles it. If you want a study done right the first time, or a second read on whether the one you already have would hold up, contact me through the show notes and set up a call with me. We've done over 65,000 studies and never caused an audit. That's the kind of peace of mind that'll help you sleep at night. And then get your 5 documents into one folder this week while you're thinking about it. Don't put it off. And step 3, if this took some fear off your plate, return the favor. Like it so it reaches another nervous investor, subscribe so the next one finds you automatically, and comment with your biggest IRS question. I read them all, and I build episodes around the ones that come up the most. If I can't answer it, I have tax professionals working with me that can. And forward this to anyone you know who took a big cost seg deduction and has never once thought about whether or not they could back it up. I'm David Weiner. This is the Tax Strategy Playbook. Build the deduction so you can defend it. And I'll see you next Tuesday on the next episode.
Thanks for listening to the Tax Strategy Playbook. If you found today's strategies valuable, be sure to subscribe, leave a review, and share the show with someone who wants to play smarter with their money. You'll find more resources, tools, and expert tips at taxstrategyplaybook.com. After all, it's your money. Keep more of it.